Welcome back to another episode of JLL Perspectives podcast. Today we're joined by Quintessential, Noel Warren, Chief Operating Officer, Dan Coleman, Head of Capital, and my colleague Tim Carr from the Capital Markets team. I'll hand over to you to introduce yourselves and tell us a bit about your role.
Tim Carr, JLL Capital Markets Office. We specialise in selling office assets ranging from 10 to 500 million typically.
Noel Warren, Chief Operating Officer of Quintessential, had the good fortune of working with the business for close to 16 years now, focusing on core plus and value add opportunities in the office and industrial space.
Daniel Coleman, Head of Capital. I've been with the business for about 14 months now. Career has been half more finance-based and half property-focused. So I've spent some time across different disciplines, capital raising, debt, asset management, you name it. But this role is focused very much on capital raising.
Perfect. We'll get straight into it. Nora, we'll start with you. So Quintessential has undergone a bit of a pivot in strategy in recent times. Can you talk to us a bit about that pivot and where you're seeing tenant debt now?
Yeah, so it's a good question in terms of the pivot. We don't see it so much as a pivot. It's more going where tenants want to be. And that's always been our fundamentals when we look at assets, whether it's in the office or industrial space. It's always, is there a depth of tenant? And the last few acquisitions we've made since probably 2023, our acquisition of 1 Margaret Street, then 240 Queen Street, and our recent acquisition of Green Square North Tower has really been driven by the depth of tenant, the amenities around the building, quality of asset, and really catering to that. So that's been a real driver for us.
Sure. And I guess, Tim, from your perspective across the eastern seaboard, where are you seeing that tenant depth?
Yeah, I think it's nuanced on every market, Jess. Melbourne is undergoing obviously a period of transition since the COVID pandemic, but we're starting to see real green shoots, pardon the pun, in core CBD locations. We're starting to see positive net effective rental growth in the east end of the city, which is excellent. And we suspect that will filter down to the balance of the market in due course. But I mean, across the country, markets like Tasmania, we just closed out a major asset sale in Tasmania, one of the biggest since 2021. And that was largely hinged on the fact that there's sub 2% A-grade vacancy in Tasmania, of all places. So things are moving. It's very nuanced in every market. Sydney continues to be the flavour. Queensland's a very buoyant market as well in the investment space. Obviously, you guys know that all too well, buying your asset up there. But very nuanced, the market at the moment.
Great. And Dan, from an asset perspective, what do you think makes an asset worth backing?
From an investor's perspective, really, and if you think about the makeup of returns being distributions and capital growth, we think that our investors are really looking for distributions. So if you translate that to what attributes does a property need to have, like Noah mentioned earlier, you need to have strong tenant depth. Tenants are buying buildings that tenants want to be in, and that's going to give you that sort of strength and reliability in the distribution profile.
And we've seen examples of that through our assets. Adelaide, case in point, we've recently done 2 major refurbs in 2 different towers, and both of those assets are now underpinned by AGL, who's moved from a fringe location, and then the other asset being underpinned by BDO and Kellogg Brown Root. And these are large leases for the Adelaide market where the tenant has said, well, to Dan's point, what's going to attract and retain best talent, and being centralised where there's the amenity, the offerings to staff, that's where staff want to be. That's what's won the race. So for us, that really just drills down to the point of why we're doing what we're doing in terms of the locations, and the market at the moment is providing those opportunities.
And Dan, you spoke about distributions. We speak to our core investors all day, every day, and it feels like there's return hurdles that most groups need to meet. What are you seeing that investors need right now to make it financially stacked for them to invest with you?
Broad brush, if we're talking specifically about office, if you can offer distributions in the range of 6 to 8% and hit an IRR of about 15%, that's typically, and this is again broad brush, it's going to be very market specific. That's generally what's going to get people's attention. It then goes to the specific market and subsectors within each market, obviously, and that's going to be able to drive an outcome. We've obviously been active in Brisbane. That's been a very simple narrative to sell with infrastructure spend, Olympic Games. We're a first mover there, so we've got some track record as well. So that's one thing. And then looking at other markets, the makeup of the returns is going to be largely driven by price as well. So where you can get a better opportunity, perhaps if we're talking about Melbourne, that's going to be something that's a bit more price driven.
I mean, it's interesting. Melbourne at the moment, again, it has been a challenged market, but we are starting to see a lot of capital now looking at Victoria because the Sydney market is so buoyant, as is Brisbane. And we're starting to see markets like Tasmania and Adelaide really surge as well. But Melbourne, you can get value here now, which I think we haven't seen for a long period of time. It's been a market dominated by institutional groups, offshore privates as well, and private family offices that are home to Melbourne. So we're starting to see a lot of interstate capital coming down, which is a welcome sign.
No, I think you're right, Tim, in terms of whether it's Melbourne or just around the east coast of the country, where you look at the buying fundamentals below replacement cost, and that's something for us historically as a business we've always focused on, and now more than ever, the economic rents for a new development are so much higher than what it is in an existing asset. So that's an attraction for us when we're looking at buildings, the ability to retain that tenant, win the race when it's 30 to 40% below new development economic rents. And then you look at the supply pipeline, office screens really well.
Yeah, I mean, we're starting to sell assets now where we're benchmarking anywhere from 50 to 60, even sometimes 70% of the value tied up in the land holding itself, which starts to become really compelling when you're looking at future opportunities for the asset.
So it sounds like equity is back for the right deals. Dan, can you tell us about your most recent capital raise and what does it tell us about the market?
So our most recent deal was Green Square North Tower in Fortitude Valley. We needed to raise $98 million as a part of that transaction. We had a 6-week raise window and we had commitments, or at least expressions of interest in the equity raise within 2.5 weeks. We were subsequently oversubscribed and had to do some scaling on that. I think that there was a very noticeable shift at some stage, perhaps it was called middle of this year, where investors, perhaps who were more opportunistic, were taking an opportunity to buy into office, I suppose for the first time this cycle prior to June this year. I think that trade was sort of more broadly held from about the middle of this year, and we started to see equity take a more sort of collective step back in. So we had really strong interest from wealth managers. Just to give a bit more background on Quintessential, we are a wholly private capital investor base, so no institutions. So wealth managers were certainly back and very interested. They were buying the Brisbane thesis. They were buying the strong tenant covenant. So it was an 80% government leased building. So we really saw a big step back into property equity. And I think that's going to continue. There's been a number of trades in, I suppose, the last 6 months around the country. Most of those equity raises have filled. Some others have also been oversubscribed. So I think that bodes well for 2026.
And I think, Dan, what we've seen from our equity partners through Green Square North Tower and historically is our investors are willing to back us because they understand when we look at opportunities, how we screen them, the entrapped value that we can effectively unlock, whether that's in due diligence or post, and have high conviction in doing so. And you might want to even talk about just high level, what the entrapped value and where that was, that really boded well for the investment thesis.
Yeah, and I think maybe to take that a step back again, we've got a great track record. That's a track record we want to protect. So we will only do exceptional deals. And I think what I experienced in the most recent raise with Quintessential was just the layers of governance that sort of go into a transaction. So that's getting a really thorough approval from the IC to proceed, from the board, and all of that being backed by really strong analysis by management. We identified opportunities in that property from a leasing perspective where we could create immediate value. So there was a major near-term lease expiry with a government tenant. NOAA has relationships as well as the business with government in Queensland. We're actually able to negotiate a lease during due diligence and the capital raise window, and have that lease in an executable form by settlement. That deal was actually signed the day of settlement and created that immediate value. And I think from an investor's perspective, and what we want to do is, in that period of time, how can we protect the invested dollar as much as possible? And by creating value like that, you immediately step up in terms of value.
Yeah, I mean, you guys adding value like that is tremendous for your investor pool, and no doubt that's why there's such loyal customer following with the Quintessential brand. And as agents at the moment, we're finding that deal security is even more important than sometimes headline price and other commercial terms in the current market. And so as agents, recommending certain buyers to different assets and their ability to either raise capital, complete DD, and make sure they hit all milestones at the appropriate time parameters, it's never been so important.
Spot on. And that's, we socialise that internally, Tim, around price versus the ability to de-risk and mitigate. And for us, first and foremost, it's about de-risking and what are the mitigation steps to do that? Because for us, it's always, to Dan's point around our track record, it's preserving and protecting the investor's dollar, number one. Then how do we add value along the way?
Noah, you mentioned unlocking that untapped value piece. Can you talk to us about what that process looks like from start to finish?
There's various machinations of it, whether it's on the leasing profile, whether it's on the capital expenditure profile. So, we recently had an amazing experience with an industrial asset in Port Adelaide Distribution Centre. We bought it in 2019, and when we bought it in 2019, one of the stigmas around the asset at the time was the environmental and contamination risks. And we purchased it off market. It was an on-market campaign that failed, and that was one of the reasons it did. And we went in there during due diligence and really got to know and understand what those issues were. So before we settled that asset, we had an environmental game plan in place that was to the satisfaction of the bank. We then effectively went and de-risked that during our first year of ownership, and we brought that back to market in a position where the risks were removed and that stigma had gone away. And that's something that we look for in assets, is sometimes maybe there is stigmas to assets. How do we de-risk it? And then that really starts to unlock value.
It also resonates with the investor market as well. I think in this market where groups are looking at every geography in every sector of the market, making sure for vendors that we're working with to provide as much detail up front on the asset itself, whether that be a technical due diligence report, heritage reports and the like, but also pathways at least to navigating how to fix some complexities with these assets. It's so important at the moment.
Noah, back to you. Looking across your portfolio, what are the assets where you think things have gone right, and maybe some learnings that you can talk to us about as well, and how has that now shaped your strategy going forward?
There are always challenges and there are always wins. And the challenges, we've had various challenges over the past number of years with the inflationary environment, and given some of the assets we have in our portfolio, the heavy regeneration uplift that those assets need to go on. We had one asset, case in point, where we wanted to deliver a major refurb through the building, and we acquired that pre-inflationary environment. So our costing levels did not match up to the rate at which inflation effectively sped ahead. But again, what we look at as a business, and the way our business has been deliberately structured by our co-founders, Shane Quinn and Harry Rosenberg, was we've effectively got three circles. We've got the capital raising side, which is Dan's side of the business. We've got the asset management side, which is all around leasing, tenant retention, tenant management, and then we've got our engineering and design component of the business, which is getting in there, understanding the asset and delivering solutions. So through this inflationary environment, what we're able to do is still deliver an incredibly high quality ground plane in this case, whilst costings were getting away from us. Because what we did is we got in there, we rolled the sleeves up, we worked with all of our design team, engineers, builders, to value manage an incredible outcome that we've now gone and delivered. So yes, there's always going to be challenges, but something that deliberately has been set out to do is how do we protect investors and the business through challenging points in time, because we're not always going to get it right.
And going back to that, in protecting investors' capital, as Noah mentioned, I do think that's quite a unique point of difference for Quintessential. That is the people on staff being engineers, builders, actual builders, and architects. When things go wrong, they can step in, and you know that you've got a friendly working for you, verifying the information you're getting from project managers or on-site building teams, and then looking at ways that we can value manage things to protect the invested dollar.
So it's quite unique that Quintessential has all the in-house capabilities for a business of your size.
Really rare.
Over to you, Tim. What are buyers gravitating towards today? Is it income stability, repositioning upside, or transitional plays?
Anything office in Melbourne? No, in all seriousness, I think we are starting to see a lot of liquidity coming back to the market. And as I said before, Sydney, Queensland seem to be the markets that groups are gravitating mostly to. And we're getting the benefit of those groups missing out and coming back down south to Melbourne. But in terms on the liquidity scale, we talk a lot about the haves and have-nots in the current market. So those assets that present really challenging locational attributes, including, you know, in the suburbs or various parts of the CBD where there's not a lot of tenant demand and activity. It's all hinged on tenant demand and activity, I think, preface that for one. And so those assets have complexities on the leasing front, but also huge CapEx requirements, as well as locational deficiencies. Very challenging to get anyone excited at a level that makes sense for a vendor to trade.
Tim, as you're seeing liquidity starting to come back into Melbourne, can you tell us about the balance or the pricing differential between buyer and seller? Is that quite wide at the moment, or is it narrowing?
Yeah, I mean, to start by, we have a global sort of system called Horizon, which is an excellent platform where a lot of our data and bid data gets uploaded real time across the nation and also internationally, which gives us excellent insights as to what's happening on a global scale. So global bids, the bid-ask spread is starting to really narrow to sort of 3% between vendor and buyer globally, which is obviously there's a lot of data coming from the US. And so that market typically is at least 6 months ahead of the Australian market that we're seeing at the moment. But from an Australian anecdote, we're starting to really see that close at the absolute sort of the trough of the market in Victoria, which I'd like to say was probably late last year, early this year in terms of sentiment in Victorian office. You know, that range from anywhere from 10 to sometimes 30% of a differential between pricing. We're starting to see that really closing up now. And in a lot of the cases, our sort of quote range at the start of the process is starting to resonate with the buyer's market. Obviously, there's some exemptions. We just close an asset out in the fringe, which is a major transaction, and bid spread range anywhere from 2% to 15%. It really depends on return hurdles and some opportunistic buyers in the market trying to capitalise on some opportunities at the moment.
And Dan, from your perspective, who do you think the most active traders will be in the next 12, 16 months?
Oh, look, I think it probably goes without saying that there's been a very long period of illiquidity in the market. So there is quite a bit of property sitting on balance sheets or in, syndicates that does need to be sold. What I think is going to be interesting is how much the bidder profile changes, because in the last few transactions, really, we've been bidding against groups that are very much like ourselves. We all know what the cost of capital is, what returns hurdles our investors are looking for, because we're all syndicators. It's been, just by way of example, for Green Square North Tower, the 3 competitive bidders were all syndicators just like us. The next 12 months, it'll be interesting to see if institutions come back into the market, perhaps longer holds, like lower costs of capital. What is that going to mean for pricing? So I think those groups that have taken advantage of opportunities over the last 12, 18 months, I think that will serve them very well. And we'll see what happens over the next 12 months in terms of if institutional capital comes back. I think we're possibly seeing that we are seeing that in Sydney already. We're in Asia in May, and APAC capital, certainly from an office perspective, it was focused on 2 markets across the sort of Asia Pacific region. That was Tokyo and Sydney. Sydney, as it gets too expensive, investors are going to have to look elsewhere. So Brisbane, it's actually a relative unknown, I suppose, in offshore markets. Melbourne's a known entity and it's got some challenges to work through, which I think it's starting to take shape. So it'll be interesting. It'll be just interesting to watch how quickly that.
I heard something the other day that was really interesting, and I hate to give a plug to our Queensland colleagues, but you can thank me later. But supposedly 3% of the world's population right now could point on a map where Brisbane is at the moment. By 2032, obviously around the Olympics time, 97% of the world's population will now know where Brisbane is. That is a dramatic change in terms of international profile for a state.
And so Paul Noonan in September will be
absolutely well, boys. Clip me in on your next one. But I mean, that is phenomenal, and there's a reason why that groundswell of activity is starting to happen in that market and all the growth fundamentals in that location. But I mean, we've seen it in Melbourne before. I think lots of people recognise that Melbourne won't be on its knees forever. There's obviously some changes in the political landscape as well, which is starting to provide some fierce competition for the current Labor Party. So time will tell. Be really interesting 12 months, I think.
Where's Quintessential looking in the next 12 months? What assets and sectors are you looking to play in?
We are an office and industrial investor. I expect that that'll stay the same. There's still a fair bit of wood to chop, we would say, in those two sectors. But generally, we are sector and geography agnostic between those two. So really we'll look for where we can find value for investors. And I think it's those opportunities where we can get in, de-risk during due diligence and settlement windows, where we can protect the dollar and drive returns for our investors. No, you've probably got a bit more specific.
I think
that you can say
that's
about
spot
that.
on, absolutely spot on. And my view is office is still a really great office asset class. Obviously, the last couple of years, it's in some circles has been a dirty word, but when you look at the fundamentals of office and again where you're buying office in certain locations, you look at the development supply pipeline that is coming over the next 5 to 6 years, which is pretty thin. Buying good quality office, I think, is a really provides great opportunity. And then to Dan's point on the industrial side, we've recently had a fantastic divestment experience, and we're looking to go again in the industrial space at present. So our teams are busily running up and down the east coast of the country at present, looking for opportunities that we believe are exceptional that we can bring to investors.
Sure. And Tim, from your perspective, where do you see the next set of shifts coming from? Is it capital, pricing, demand? What does it look like from agency side?
Yeah, look, I think the demand component is really important, the tenant demand piece. As I said, all investment decisions, particularly in the office landscape, are just driven by where are my tenants, how much will they pay, and what's my incentive, really. That's what it's coming down to. And at the moment, there's 22 briefs in excess of 4,000 square metres of tenants looking for CBD space. I mean, that is more so than historical averages. 17 of which haven't been committed yet. There's 5 that are on heads, but there's 17 movements, you'd say, in the next 6 to 12 months, where they're either staying put or they're moving to new premises. And it'll be really interesting to see the tenancy profile and the changes in the next 12 months, which will inevitably drive investment decisions. We'll start to see some offshore capital groups looking to trade out of Melbourne potentially just because of uncertainties in the tax landscape, but also global opportunities as well, that I think when we're down in little old Melbourne, we don't think that there's this whole other world out there where there's serious returns to be had elsewhere. So I think we'll start to see some of those groups trading out, and that creates an opportunity for local groups like Quintessential to capitalise on a market that we haven't seen for a period of time. The syndication style product at the moment is rife, and I think that'll continue for the next 12 months.
No, I understand that Quintessential gave JLL the national portfolio management. Can you tell us a bit about that relationship and how it's transpired and a bit of the work that we do together?
So only about 3-4 months ago, we appointed JLL to run our assets nationally. So currently that's 12 assets on our portfolio. And for us, we look at asset management and the way we run our buildings pretty simply. It's tenants first and foremost, and then the day-to-day operations that run around that, and the full circle disciplines that JLL provide, from operations management, property management to technology solutions, which in this day and age is so important and is continuing to evolve. we were incredibly comfortable to provide that platform, and then delivering effectively and developing a partnership over the coming years that we hope can deliver fantastic experiences to all of our tenants across the country. Because first and foremost, if we don't have tenants, life's pretty hard. So it's all about retaining the tenant and those day-to-day experiences.
Well, sounds like there's lots of opportunity, as you mentioned, lots of wood to be chopped in industrial and office. So
I like that.
all positive here for us. Thank you all for joining us today. It was a great conversation, lots of interesting insights, and thanks for joining and thanks for listening.
Thanks.
Thank you.
Thanks, Jess. Thanks, Tim.